Welcome to NABE TV. I'm Ed Hyland. I'm joined today by Sally Chen. Sally is the chief economist with Fisher, Francis, Trees & Watts. FFT&W is a privately owned investment management firm with approximately $18.6 billion in assets under management. Sally, thank you so much for coming by and joining us today.
Thanks for having me.
You know, here at the NABE Policy Conference, there's been an awful lot of discussion about what is going on. I mean, the buzz is what's happening with the new Obama administration. We're talking about fiscal policy. We're talking about the budget outlook and the projection over the next several years, up to 10 years. Let's talk a little bit about the shadow banking, if you will, and the destruction of the shadow banking system. Why don't we start right there with this destruction of the shadow banking system? Lay that out for us in your view.
Yes, the shadow banking system essentially is the market that securitized a lot of these loans that indirectly had increased lending to consumers and businesses. So the form of shadow banking system that you and I can see are in the form of asset-backed securities, for example, commercial mortgage-backed securities, for example, that increase lending to households who are looking to buy mortgages, to students in terms of their college loans, car loans, those sort of things. So the shadow banking system really has had a very dramatic impact in terms of the availability of credit to households and businesses. And what we've seen in the recent financial crisis is that securitization and that whole what we call shadow banking system collapsed. That securitization really screeched to a halt. In fact, you know, what many of us know these days, unless you can qualify for a conforming loan mortgage that are guaranteed by Fannie and Freddie, it's very, very difficult for consumers to take out a mortgage loan. So that's one form of really the collapse of the shadow banking system that's really affecting real economic activities, real business and consumer lending and borrowing and spending and investment. And
isn't that the purpose of the Federal Reserve and literally flooding the market, and the stimulus plan literally flooding the market with dollars, is to essentially reinflate the banking system?
Yes, you see the Fed doing that on several fronts, and obviously looking at the Fed's balance sheet and looking at what the Fed has done, the Fed has actually very aggressively done a few things. It's addressing bank reserves, so it's really pushing up bank reserves to a historically high level. But it's also very surgically has entered into a whole host of credit markets to really in the hope of stimulating lending activities in those markets. And that's what has set the Fed apart from what it has traditionally done. And that's what's making the current environment and the current set of monetary policies very, very unusual.
I use the term reinflate, and that makes me think of inflation, and obviously in growth and inflation. What type of outlook are you seeing? What's implied by the yield curve and the tips at this point?
Oh yes, very interesting questions, yes. I mean, the big question right now is, can the Fed and can the Obama administration really effectively reflate the economy? And when you have this kind of deflationary spiral, prompted by asset sales, it's critical that we halt this kind of asset price decline. But if you look at the capital markets, if you look at the fixed income market, they're telling us several interesting things. One is if you look at TIPS break even, which is really a market implied a set of inflation rates. Those rates are suggesting deflation out to the 8-year horizon. So when people say we are no different from Japan, when you look at TIPS break-evens, it suggests that actually investors think that we are not that different from Japan. That's the first thing. That's quite interesting. Now, you have to take the TIPS market with that sort of signal with a grain of salt. And the TIPS market is not as liquid as the nominal treasury market, so there might be that signal is muddled a little bit. But by and large, it's a very useful signal for policymakers and for investors, and that does suggest deflation. But one thing that's been interesting to me, and I think this is something that many of us haven't really had the luxury of paying attention to amid all these negative news that's been pervading the marketplace, is the shape of the yield curve. Now, the shape of yield curve, if you look at what we call yield spread between the 3-month bill rate and the 10-year coupon yield, that spread, that shape of the yield curve, is actually a very useful indicator of recession. We have a model in-house that uses this yield spread as a forward-looking indicator, predicting will there be a recession or not a year down the road. Now that spread these days, today, it's roughly about 200 basis points. It's slightly flatter than the historically steep level we saw in November of last year, but it remains fairly steep. And what that means is this. Traditionally, when you have an inverted yield curve, short rate higher than low rate, that has been a very good indicator of recession. And in fact, it predicted the past 7 recessions as defined by NBER. Now at 200 basis points, what's telling us is, despite all the gloomy news out there, that's actually suggesting that 12 months down the road, the probability of recession is fairly low. It's less than 10%. So some silver lining out there.
But does that not give us a mixed signal in the sense that we have perhaps a lesser chance of a recession, but a greater chance, if we were looking at some of the other data that you're relying on, of a deflationary environment, which is also not good for our economy?
Right. This is where, as an economist, I will say, where economic analysis really comes in, and this is where it's useful to provide some context, some baseline for market analysis. And I would say, in terms of break-evens, what's suggesting that, as I mentioned earlier, that market has been befuddled by some liquidity concerns. When you have an environment in which investors are very risk averse, as we saw towards the end of last year, they tend to flee these kind of markets and dive into safer haven assets such as nominal treasuries, which is what people are comfortable with, and specifically treasury bills. And when you have that sort of movement from investors, TIPS break-evens tend to actually provide a signal that's not entirely accurate or clear. So that's why I mentioned earlier that be careful when you don't rely entirely on break-evens as a gauge for inflation. That said, if I just step back a little bit and scan at the policies and the economic landscape, I do have to say that I think on some levels I am optimistic in terms of the outlook further out. Now, part of the reason is, again, historically, if you look at just the trajectory of growth, when we have recessions, we tend to recover fairly swiftly. And when we have deep recessions, we tend to have pronounced rebounds, precisely because after periods of severe contraction of investment and spending, there's tremendous pent-up demand. And consumers and businesses tend to respond to whatever incentive they have and act accordingly. They are rational on a lot of levels, despite what we say. So if you look at all the programs that's been put in place by the administration, I do think that there's a very good chance that the economy will rebound into positive territory in Q4 of this year. That's one thing. The second thing that's notable, and we've talked about this repeatedly at this conference, is what sets the current crisis apart is the global nature of this downturn. We cannot count on any particular trading partner, or we cannot count on really rebuilding our export capability to lift us out of the current downturn, as Japan did following its decade-long economic malaise. But what is unique in this environment is that globally, all the major economies, all the governments are actively engaging in introducing stimulus packages to re-stimulate the economies. We know about the Obama administration, roughly 3% of GDP per year for the next 2 years, and a little bit further down the road. China is very aggressive in introducing stimulus packages. Germany just introduced, for the third time, I think, after third iteration, one of the largest, actually the largest stimulus package post-World War II. Singapore, similarly, very aggressive. So when you have this kind of coordinated, really on some levels, coordinated stimulus efforts from these major economies, it's really hard to imagine that won't have some impact on demand for commodities, on economic activity, on building and construction activities. That's where the optimism is.
As the old saying goes, the rising tide will float all the boats, so to speak.
Let's hope so.
All
and
right.
This time we go out roughly together at the same time. Hopefully we'll come out more or less within a narrow time span as well.
Sally Chen, thank you so much for coming by and sharing your views with us here on NABE TV.
Thanks for having me.
And thank you for joining us. Much more straight ahead on NABE TV.